Hello everyone. Let's discuss the elephant in the room budget. Let's discuss what we can expect from this upcoming union budget, which is scheduled to announce on 1st of February 2023. To be honest, at present, there are three problems that India is facing: fiscal deficit, current account deficit, and reduction in personal disposable income. So, in this video, first I like to highlight those in detail, and then we will discuss about what market wants, and finally what I think will happen. Let's start. First one, fiscal deficit. For those who don't know, it means it's the difference between government expenditure and the government revenue. How much money Indian government has to borrow in percentage of total country's GDP. Historically, in normal times, Indian government used to maintain around 2 to 3% of GDP. But in order to support the unusual situation in 2020, Indian government increased the borrowing for FY 2021 to over 9%. Then again for FY 2022, India's fiscal deficit was 6.9%. It means Indian government borrowed 6.9% of Indian GDP worth money from the external source. And for the present financial year, they are targeting for 6.4% of Indian GDP, which is really a huge borrowing. Almost all the major economics in the world's top 10 got the less fiscal deficit compared to India, except US and Italy. So now for the upcoming fiscal year FY 2024, market wants the Indian government to reduce that fiscal deficit to 5.8 to 5.9% from 6.4%, which will be roughly equal to around 198 billion US dollars. Honestly, I don't see that going to happen at all. I believe that Indian government will continue to have the fiscal deficit target of at least 6% or over 6%. And I genuinely think that will be the right thing to do as well. To be frank, let's think out of the market for one moment. At present, almost all of us know that there will be a global slowdown or the possible recession in 2023. So, for the general public, it's really important to have higher government capital expenditure spending to support the GDP growth rate. But it also posting a question that how the government will generate more income. Then the one possible quick way is to do more disinvestment on government stocks, which market don't want since it will crash the stock price. In FY 2023, Indian government targeted to generate around 65,000 crore rupees through stock disinvestment, but it didn't happen due to the non-favorable market condition. Mainly due to the low LIC stock price. And at present, market expects and wants the government to limit the stock disinvestment to just 40,000 crore rupees in FY 2024. So here, for sure, I expect the market to get more disappointment. And then another possible quick scenario is to increase or adjust the capital gain tax. Just for info, this 2023 budget is very close to not so famous 2018 budget. Why? Both are and were last full year's budget before the Parliament General Election. As most of you know, 2018 is the first time Indian government introduced the capital gain tax in the stock market. And because of that, throughout 2018, stock market was in a consolidation. Back to now, 2023, at present, India got various capital gain tax for different asset classes. For example, in stocks, if we hold it longer for over 12-month period, then it is considered as long term, and long term capital gain tax of 10% is applicable. Whereas the holding period is less than 12-month means, then it is considered as short term, and short term capital gain tax is 15%. But in case of land and bonds, that long-term capital gain tax applicable only if the minimum duration is 24 months holding period. So the worry here is, and what the investors are afraid of is that the Indian government might be going to make it as a common 24 months minimum holding duration for all, including stocks, instead of present 12 months. And market absolutely don't want that to happen. Again, here too, I expect the government will do exactly the opposite to what the market wants. Just for info, the present India's tax to GDP collection ratio is 11.7%, which is higher than US 10%, but it's way less than that of the similar size economies such as UK, who got the tax collection of over 25%. Then the second issue, the government got the possible increase of current account deficit due to its huge dependence of oil import. It means that India is importing more goods and services than it is exporting. So, in order to push the foreign export, market expects the Indian government to deploy or add more number of products into the PLI scheme, especially the employment rich sectors such as food, housing, textiles, health and education. I mean, in FY 2022, Indian government first announced the PLI schemes for 13 sectors with a budget allocation of near 2 lakh crore rupees. In terms of dollar value, that time it's 26 billion US dollars. Then in FY 2023, they added another 10 billion US dollars or 75,000 crore rupees on top of that to boost the semiconductor manufacturing. And now the expectation is to include much broader and wider manufacturing sectors like toys, footwear, leather, and bicycle, etc. I think here the union budget will deliver what the market wants. Then the third issue, the government got the reduction in people's purchasing power. I mean the reduction in ability of households' disposable income due to the higher inflation. Here, market expects that the government to increase the minimum no income tax slab rate from 2.5 lakh rupees to 5 lakh rupees. And here my question, why government has to do that in this financial year? Guys, be rational. Government don't bother at all about the day-to-day movement of stock market. All they care for any ruling party is people's vote. So, increasing the tax slab rate this year will not be an effective way since people will forget in May 2024, I mean during the next general election time. However, if they raise the no income tax slab rate in the next financial year, then there will be a high possibility that will convert into a vote in 2024 general election. Here, I'm not blaming the ruling party. For that matter, any party in the present situation will do exactly the same, that increasing the tax slab rate in the next financial year, I mean on FY 2025, rather than increasing in the upcoming financial year. There is a chance that Indian government might increase that to 3 lakh rupees from 2.5 lakh rupees, but I'm not seeing the chance that might increase to 5 lakh rupees. Anyway, I may be wrong, but this is what I think, that as a overall this budget will be against the market expectation. Again, it's all just my opinion that what government might do, but I can be completely wrong and the budget might come as completely in favor of the market. Let's see. So that's all in this video. Hope you all got some useful information. Please consider subscribing the channel and liking the videos. It will help me beat the YouTube algorithm and will also motivate me to do more. Please don't make any investment decision based on this, as I'm not a SEBI registered advisor. I'm doing it for my and viewers' educational purpose only. Thanks for watching.